we'll just quickly brush up a few basics of working capital. So what is working capital? It is, just to give you a very simple definition, it is current asset minus current liabilities. And basically, as we discussed in our previous two examples, how the cash flows from creditors, debtors, and inventory, that is your working capital cycle in short, right? Now, what do we have in cash? We have these items. Most of you are already aware of this. Cash, inventories, receivables, prepaid expenses, loans and advances, accrued income. These are all current assets. What do you mean by current assets? Simply understanding, these are those assets through which you can recover cash. When you use that assets, you can recover cash from it. And what do you mean by current liabilities? Payables, outstanding expenses, pre-received income, tax payable, dividend payable, and short-term loans. Again, in short, what are current liabilities? Current liabilities are those liabilities where you have been given a temporary period to hold some other people's money, which you have to pay out, right? So that is how. So in case of current asset, you are expected to get cash out of it. And in current liabilities, you are expected to pay cash out of it, right? Now, how do you fund your working capital? Now that we have a fair idea about what is working capital, we need to know how can we fund the working capital. Best businesses are those which fund working capitals through customers and suppliers. So as we discussed in the Amazon example, their customers pay immediately, right? So you don't have other options. You can either pay online instantly, or you can opt for pay for delivery, as in when it is delivered to your home, right? So you have only two options. So generally within 7 days they deliver all the products in people's home. So their debtors is always minuscule, right? Almost negligible. And negligible in terms of the operation they do. And in terms of suppliers, we have already seen how much credit the suppliers give, and that is why they always have a lot of sundry creditors lying in their balance sheet. The third method is inventory management. There are businesses, and like automobile businesses are something which immediately comes to my mind, because Toyota invented this just-in-time inventory management system, which basically, which basically helps you to have a lean inventory. Because you are having a lean inventory and you are following a just-in-time process, you have far less amount of working capital tied up in inventory. So that is also one way of funding working capital. And many companies in India, specifically two-wheelers, are already following that kind of just-in-time principle. So if you go and check their balance sheet or working capital details, you will find that they also have far less inventory compared to the sales they are making, right? So these three are the best way. So first two, customer and suppliers, are by far the best. The second would be inventory. And the last one, which is the only option when you don't get any funding through the first three, that is loans. So loan, as we discussed in the previous chapter as well, loans or debt, it's not bad. It's just that as an entrepreneur or as a business owner, you must know how much is your capacity to pay, and you should be conservative. Unless you are conservative in taking up loans for your business, you are setting yourself for a risk or an unforeseen circumstances like COVID and all, where if your business activity goes down, you find it hard to make your loan payment on time, right? So that was all about funding the working capital. Now let us just spend some time to understand what was just-in-time method of Toyota and how they actually saved a lot of time and money which is tied into inventories, right? So they have these four basic principles which they follow. So the number one is the order information is quickly incorporated into the production line. So they are always aware what is the order they are going to get, and they only work towards those kind of orders. They efficiently produce vehicles with different specification one at a time in a timely manner while ensuring high quality. And only those parts that have been used up are retrieved in a timely manner. So that leads to efficiently producing and replenishing only those parts that have been retrieved. So they don't, so they at the factory level, they keep very few inventory or inventory related parts, because they believe that if they can manage the whole process of how the inventory, how the whole batch is getting managed in terms of when the customer puts an order, uh, and how it leaves the factory after production, they are always in a much better position to plan the whole inventory in such a way that at any point of time, their factory always have minimum inventory. And minimum inventory means lesser capital tied to the inventory. And that means, in effect, lower working capital intensity. Now let's come to a very important part, which is very important for us as investors. We would highly recommend you to read this blog post by Professor Sanjay Bakshi. We keep referring to this blog post. This is a 9-year-old blog post, but we feel that it is timeless and you can always go and refer to it. One particular point in that post is very relevant here. So what he says is, wherever you find large negative working capital, absence of debt, a liquid balance sheet, and high ROC, it's very likely the result of a moat. The moat, which gives its owner market power, allows it to dictate terms to its suppliers and customers. This results in the creation of long enduring floats, right? You can always go back to the Amazon example and see. You have seen there, it's a large negative working capital. And because of that, there is absence of debt, a liquid balance sheet, because the cash is always lying on the balance sheet, and a high ROC. And also, why this is happening? Because they can dictate terms to their suppliers and customers. To the customers, they can demand immediate payment, and to the suppliers, they can say that we will pay you in 2 months' time. Not many businesses can do that. There are FMCG brands. There are a few other B2B businesses as well, which fall into that criteria. But you can check on Screener. You can look up their balance sheet. You can read the annual reports. Not many business you will find under this criteria, right?